Merchandising.
I'm a lit kid beat.
In the previous chapter, we were informed that a service-type business from the name itself focuses on performing services to customers to earn profit. A merchandise business, on the other hand, is a type of business that facilitates the buying of finished goods for sale to customers as means of generating profit. Two main examples of this business type are retails and wholesales. So we will see an illustration in here. Below shows the main difference between the two. Now for the retail column, we call them as retailer or retailers for their source of purchased inventories or pagkukuhanan nila ng supplies would be from a wholesaler, and their inventory quantities sold would be like they only sell in portions, like in small quantities towards customers. As for the wholesale column, we call them as wholesaler or wholesalers for their source of purchase inventories or pagkukuhanan nila ng supplies would be from usually directly sourced from a manufacturer, and their inventory quantities sold would be, well, they sell in bulks like wholesale to smaller businesses. The operating cycle of a merchandising business involves purchasing of goods as addition to inventory, selling of purchased goods from inventory to buyers, collection of payment from buyers. Kindly observe the illustration that will appear on your screen right now. Inventory is a very important element in a merchandising type of business, as most of its transactions and operations directly affect the inventory account. In the sense of merchandising business, inventory is generally defined as the finished goods held by a business that is readily available for sale to buyers. These are the common inventory transactions. In transfer, you record it as a purchase of an asset on account or for cash, while in sales section, you record it as a sale on account or for cash. In return of goods, you record reduction on payable if purchase was on account or refund if purchase was for cash. In sales section naman, record reduction on receivable if sale was on account or refund if purchase was for cash. For the reduction of goods, price record as discount are a reduction to purchase price, while in sales section naman, record as discount a reduction to sales price. Now for the freight, for the purchase section, add to inventory value if goods are shipped at FOB shipping point, while in sales section, add to selling expense if goods are shipped at FOB destination. In recognizing transactions that affect the inventory account, we need to consider the two perspectives that could determine the inflow or outflow of goods in the inventory account, the buyer and the seller perspective.
On the perspective of a buyer, it provides an inflow of goods to the inventory account, as goods that are bought will be added to the total inventory count of the current period, which will be available for sale. On the perspective of a seller, it determines an outflow of goods, as goods from the inventory for the current period will be sold to buyers and become deductions to the total inventory count. The flow cost of a merchandising business is as follows. Beginning inventory, add cost of goods purchased equals cost of goods available for sale less ending inventory equals cost of goods sold. It is a pro forma solution that businesses use to determine the ending balance of the inventory account, or the cost of goods that are still available for sale for the next period. In operating or starting up a merchandising type of business, there are two things we need to account for: the perpetual inventory system and the periodic inventory system. These are inventory systems the businesses use for their recording of business transactions concerning to purchasing or selling of goods. The word perpetual means continuous or never-ending. Hence, perpetual inventory system is defined as such because the inventory account is updated every time the business makes purchases or sales. This gives an impression that the inventory account runs a continuous or running balance of the goods on hand. Cost of goods is also updated in each purchase or sale transaction the business makes. Unlike perpetual inventory system, a business that uses a periodic inventory system only updates the inventory account when a physical count of the inventory is performed. As the name suggests, the amounts of the inventory and cost of goods sold are only determined periodically, daily, weekly, monthly, or annually. Transactions on a perpetual inventory system, such as sales, purchases, returns and allowances, and purchase discounts, will be recorded as either increase or decrease to the inventory account. On the other hand, transactions on a periodic inventory system will be recorded to the accounts that correspond to its transaction name. Example, purchases will be recorded as purchases, sales will be recorded as sales. Depending on the nature or the current circumstances of the business, one of the two systems can be mostly effective. A perpetual inventory system is mostly effective for bigger businesses as equipments such as scanners are expensive and can only be afforded by larger businesses. The periodic inventory system is mostly practical for small to medium-sized businesses as they may not have the capital to buy the equipments necessary for the implementation of the perpetual inventory system.
Another important element in a merchandising business is the free on board or FOB. Freight terms can either be expressed as FOB shipping point and FOB destination. It determines when the ownership of the goods are transferred upon shipment and who is responsible for paying the freight cost. When the term of a purchase is FOB shipping point, the freight cost will be shouldered by the buyer, and the ownership is already transferred to the buyer upon the delivery of the goods to the courier. Hence, the freight will become an addition to the inventory cost of the buyer. When the term of a purchase is FOB destination, the seller is obliged to pay for the freight cost and the ownership of the goods will only be transferred as soon as the goods are delivered to the buyer. Hence, the freight cost becomes part of the operating expense of the seller. Now let's go to returns and allowances. First, we define what are returns. Returns are goods that are returned by the buyer to the seller, maybe due to item defects or wrong item deliveries. Allowances, on the other hand, it is when the buyer may opt to keep defected or misdelivered items with the condition of receiving a deduction of the original cost of the item. Now, let's talk about discounts. There are two types of discounts that sellers apply to their inventory products, and these are trade discounts and cash discounts. Trade discounts. Trade discounts are basically deductions to the list price of the item to entice customers on buying products in huge bulks and quantities. It is commonly used to conceal the true price of a merchandise for competition purposes. For example, when a merchandise with a listed price of 10,000 pesos is granted a 10% trade discount from the original price, the merchandise will now be sold for 9,000 pesos. The amount of the discount will not be recorded in the journal entry, as the purpose of trade discounts is to conceal the true price of the merchandise to hide it from competitors.
Cash discounts are discounts used to encourage buyers to settle outstanding accounts quickly at a reduced price. Unlike trade discounts, the amount of the discount from the list price is recorded in the books as discounts. Credit terms indicates the amount of cash discount at the time period in which it is offered. Below are examples of credit terms for cash discount. Example of a cash discount is when a merchandise listed at 50,000 pesos is offered a credit term of 2% in 15 days and none in 30. If the merchandise is paid within 15 days, starting from the date it was purchased, then a discount of 1,000 pesos will be deducted to the listed price. As additions to the account titles that we are able to encounter on a service type business, purchase. Purchase is an asset that has a normal balance of debit. Freight-in. Freight-in is considered as an adjunct account which it provides additional values to the accounts. It has a normal balance of debit. Purchase returns and allowances. Purchase returns and allowances is a contra asset account which is a deduction to an asset account, and it also has a credit normal balance. Purchase discounts. Purchase discounts is also a contra asset account with a credit normal balance. Sales return and allowances. Sales returns and allowances is contra revenue account which is a deduction to a revenue account with a debit normal balance. Lastly, sales discount. Sales discounts also a contra revenue account with a normal balance of debit.